Hello, everyone. Welcome to The Enlightened Investor. We've got an excellent show for you today, and it's been a while, hasn't it, Mike?
It has. I'm sorry.
Yeah.
Summer. We kind of get busy in the spring.
A little bit of golf, a little bit of fun.
Yes, we're here though. We're ready to get back at it.
And I'm glad that I'm working with you.
And we're color coordinating today. We did not talk about this either.
Not at all.
No
Not at
schedule.
all. Well, folks, today we got a great day talking about how passive investing has triumphed active investing for the first time in our lives. I mean, it's been 30, 40 years, been waiting for this. The evidence has always been there. But man, finally, after, John Bogle will be looking down from heaven, I would say, on this one.
Well, yeah, and also, I think we need to preface what active and passive investing is, just so everybody gets this.
Yeah, sure. You want to take it?
Sure. So, active investing, when you have a fund or you have a portfolio, you have an account, you have a manager or a team of managers, and they're selecting stocks based on their forecast that they're going to have higher returns in the market, or maybe they're doing a combination also of market timing, sector selection, technical analysis, fundamental analysis. But the bottom line is and typically what you find with a portfolio like that too is they're very concentrated. They maybe own 20 to 100 names when the market's several thousand stocks.
Right.
And we're going to just go through the data. And then on a passive portfolio, you can buy different style sectors, or you can buy an asset class, or you can buy a whole market portfolio with an index fund or an index ETF. And that's what's called kind of passive investment management. There's not active decisions made on a daily basis with a concentrated portfolio. They're very broadly diversified, and these can be had now at an incredibly low cost as well.
Cheap fees.
Very powerful tool for building a portfolio.
Exactly. Retail investors have never been in better shape.
Right.
So today's episode, kind of the takeaways, and the reason you want to watch is because we're going to take a look at sort of the history of this and how quickly things have changed. We'll look at the literature, what the literature is saying, and the rates of return. And at the end, we'll take a look at a hypothetical person who's investing in active kind of strategies, and then we'll take a look at sort of a person who's investing like
in the base rates.
In the base, that's right.
That's for a myth.
Yeah, that's right, for a minute. This is
Just
for you,
in case
Amit.
he's watching.
Yeah, that's right. All right, so the first thing I want to show you is this slide here on index funds overtakes active investing. You can kind of see that over time, really there's this change that the passively managed funds or not managed funds are starting to catch up, and they finally did it in 2022. Amazing. And in fact, if you look closely, you can see that in 1993, that was not that long ago, there was $1.25 trillion of retail investing into active and only 21 billion into index funds.
Wow.
And that's 60x difference. Mike couldn't even believe that himself, and he's been doing this for 30 years. And then in 2022, it's actually flipped. So hey, he doesn't even remember this. He emailed me this quote. He said, "This is the democratization of investing and a win for the consumer."
That's huge.
You want to talk just a little bit about that? It is huge.
Well, it really is, because like we were saying earlier, basically you can build an institutional level portfolio now as an individual investor that's well diversified at an incredibly low cost.
Yep. What a win.
It is.
And let's go this one here. Let's take a look at some futility of so the listener is like, how bad is it? Like, there's a lot of people out there who are really smart. They don't have to have PhDs, but they think they can outbeat the market, outguess. How well do they do, Mike?
Not well. The markets, that's the whole premise behind why this works is, the markets are very efficient at pricing, right?
Yes.
And what you see a lot is the peer group studies, and you want to be leery of that, because this study here, what they're doing is with a peer group study, they remove all the losers and all the closed funds, and all their bad performance disappears.
Just get away.
So what this study does is they bring all the losers back in and compare their data. And when you look at this, this is showing equity funds, okay, for the last 20 years. Mm-hmm. They started out with 2,800 funds. Only 44% survived that 20-year period.
Incredible.
And then when you look at the winners, and this is compared to the relative benchmark index, 18%. So, if you're going to pick odds for an investment strategy, going active puts you on the wrong side of the odds.
That's right. Folks, that's almost random luck. It's like 1 out of 5 chance that you're going to beat the market. And it's almost like random chance.
So basically, were the winners lucky or were they good?
Exactly.
Right? Then you got to untangle that as well.
Like, remember we talked about ARC, Kathy
Yeah,
Woods and
right,
ARC funds? Yeah,
right.
they're...
And the same thing when you look
for
below,
fixed.
the same things occurs with fixed income as well. It's not
Yep.
just, and also we didn't put up the international, but I mean, the same data basically shows up in the international numbers as well.
Yeah, and all kinds of, and again, like, this 18% that overperform, how do they actually end up doing, like, right?
Right, with
and the
persistency,
persistence.
right? Yeah.
They
Same.
can't continue to do it in the long run.
Yeah.
So-
Top 25%, only 21%.
Yeah.
Yeah.
Like one of the quotes
Back to your luck again.
Back to your luck again. One of the
Right.
things that Mike said like 5 or 10 years ago, folks, he said, we were talking about like stock picking. I said, well, what about Warren Buffett? And he said, well, show me another person. And I'm like, yeah, that's about right. Because it's very challenging to
Yeah,
continue
and also,
to,
but if
over
you
a
know
long
anything like
horizon.
Warren Buffett,
He
I
was
mean, I
value.
use one of his letters
Yeah.
though that he's a fan and tells even institutional investors they should be index investors.
Right,
Even
he does do
institutional.
that. His
So
own-
even though
his own-
this is the best stock picker on the earth, according to most people, right?
Yeah.
Yeah.
Okay. And this stuff, this is another slide here from Spiva, and I think this is nice because it gives the individual listener, look at all the different benchmarks and the underperformance of all those different benchmarks.
Right. This is a good graphic. So, yeah, Spiva is a report produced by Standard & Poor's every year, and they do. And again, this is one that brings in the survivorship bias of all the products. And I mean, you look across the board on these, they look at each asset class for U.S. equities, and I mean, these numbers are stunning. I mean, why would you ever have a manager trying to pick stocks and beat the market? I mean, when you've got all this collective wisdom out there that's very efficient.
Yep.
They're there for the taking.
Exactly. And you know, who's actually winning from all that recommendations, right, Mike? I mean, it's
Right. It's all the transactional people.
It's all the
The
transaction.
manufacturers,
the middleman,
the proprietary
right?
product.
Exactly.
Right.
All right, so let's get hang with me on here, but I want to get to a little bit of some research because I want to let you know, like, yeah, we threw up some great slides, but what is the research saying? And so this is Larry Swidrow. He's got a great book on the incredible shrinking alpha. And alpha is the idea of trying to outperform a benchmark with a consistent amount of risk. Is that the best way to say it?
No, it's actually alpha is where you actually did it with skill.
Oh,
You're
what about
actually
the risk
added
factor?
skill.
Okay, just with skill.
Right.
And
Well,
that's been
beta,
shrinking,
yeah.
right? Yeah, so
Right.
you're outperforming beta.
Right.
And so there's a lot of reasons why it's becoming increasingly difficult. And Larry mentions like the pool of victims to be exploited has been shrinking. There's more academic literature. There's a lot of smart people seeking alpha already. And it's almost, there's like this paradox of skill. Like the more and more people and hedge funds are trying to outperform, someone's got to be a victim and
it comes
underperform
back
to have an
Fama's
overperform.
work, right? Efficient
Yeah.
market hypothesis. I mean, a good example of that. I mean, the people need to look at the collective wisdom of the market. I mean, there's a lot because you have all these institutions and all these people managing funds and everything and undercovering stock prices. And it's not like it was 30 years ago when Warren Buffett, was easier to find a value stock, one that was underpriced.
Yes.
And an
Now-
example of this is like D.E. Shaw, their hedge fund in New York City. They have like 80 PhDs, one firm that are out there using programs to find anomalies in stock prices. So when you put the collective wisdom of all these firms together in the market, that's why all the markets are pretty efficient. They're
Folks,
not perfect, but they're pretty darn good.
That's a takeaway, folks. If they can't do it with 80 PhDs, then how can?
How does your local broker, local little advisory firm in Peoria or whatever?
But we recommend this book. We're going to put it up there, and I'm going to do one more article. Kind of a shout out here to Jones and Moe from 2021, out of sample performance of mutual fund predictors, and the review of financial studies. A long quote, but really I'm going to kind of maybe go to the end here in the quote. The clear implication of their article, their research, I kind of read through it, is that investing practitioners who are known to use at least some of these measures to guide portfolio selection may be engaging in an exercise that is dubious relevance. It's just this, it's not there. The overperformance is not there active. So we'll throw in that article as well as this incredibly shrinking alpha. So we want you to go read these because one of the things we do here at the Enlightened Investor Show is we want you guys to learn as well. And the more you learn, the better you are at your investing life. So the last thing I want to do here let's do a hypothetical, and then we have some takeaways. Let's take a look at one of the famous people today in media that promotes actively managed funds, Dave Ramsey.
I do want to mention, I'll defend Dave a little bit, though. I really do like his work he does in debt management for people.
Me too.
I just think he
I've
kind
used
of
him on
misses,
that.
he misses the boat sometimes here on his investment recommendations, so we'll see.
Well, maybe you could say, Mike, he's like an expert at debt management,
Sure.
but then maybe with regards to investing, he should
educate
himself a little bit. And I think we need to continually do that. We're wrong too sometimes. So you can see here, like, Dave Ramsey has, he's got a business model where he has these preferred providers that plug people into their 5% loads, right? Like you go to see someone, they get you in the mutual funds that are actively managed.
Explain a 5% load.
And they get you in like
Upfront commission.
Upfront commission of 5%. That's a standard for the industry, right? Like what we want you to go is we want you to go into a place that that don't have loads, right? So you can keep more of your money. Also, he believes in this actively managed idea. So he says it's fairly easy to study mutual funds and pick the ones that outperform. And so what he does on that, he says, it doesn't take a rocket scientist, he says, to outperform the market. He just essentially says, I just look at past performance. And we know that's the reversion to the mean, buddy, right?
It didn't work out for ARC very well, did it?
It didn't work out for ARC. So anyways, let's take a look at two individuals, like passive Pauline versus active Dave. This is a hypothetical investment where we have some assumptions. And what we're going to say is that each passive Pauline and also active Dave, every month they save $1,000 for $12,000 a year. So they just punch it in every month. And then active Dave goes to his preferred providers and they pay a 5% load. And so right up front, you're only going to work with $11,400 versus the $12,000 that actually passive Pauline puts in. And then because active Dave's using active investing strategies, his performance is going to be lower than trying to just overall be in an overall benchmark.
Right.
So we're going to give him a 7% return and give passive Pauline an 8% return. So here's the results the hypothetical results over 40 years. Take a look at this, is that passive Pauline has 3.1 million and active Dave has 2.2. That's a lifetime of wealth. That $900,000 of lifetime wealth. Now, what's interesting, folks? Just 1%. I want you to pay attention to this. Is that what is driving this decline of the active Dave investor is not the 5% load. It's actually the lower return over the 40-year horizon, and that makes up, what is it? I calculate 85.7%, ladies and gentlemen, of why active Dave is underperforming. Is that incredible?
I don't know the actual study, but I'll throw this number out there. Roughly, I think there's a study out there that shows if you're talking about active passive management too, and you're talking about taxable dollars, that the hurdle for the active management is about 2%
yes.
of the return due to taxes.
Yeah, we were talking about that
huge.
pre-show.
Huge.
So, Mike, I think what we can do is, like, folks, if you listen to this point, we wanted to say this is really powerful stuff, and we want to give you some takeaways. So, again, like the takeaways are, number one, research shows that active investing doesn't beat the market because efficient market, as Mike was saying, and it's more about random chance. Let the markets work for you and control what you can control. And some of the things, I'm going to recommend another book, and Ryan will put this on, that, just keep buying. Like every month, like just keep buying the broad-based indexes. Control, keep your fees low. Like don't get into load funds. If someone's selling you like a load fund, you might want to question them. What am I getting for that? Right? You might want to question like what's the benefit for me on that? Because I can kind of see that I could just go and get these low.
It's really amazing to even have that product still out there.
I know, and they're everywhere.
Because no load's been around for so long, and even prior to even indexing, at least they had no load funds.
Yeah. So anyway, save, be diversified, stick to it. We're in a weak market right now. Ryan was talking to me about how the NASDAQ's down 30% before the show. Stick with it.
Well, and the plan is the important part. I mean, we beat this to death every time we talk. But I mean, you got to have a plan. And quite frankly, just because you have even if you have just a basket of ETFs or index funds, which I see sometimes, there's no thought process to it. They just throw them in there, and maybe I think at times they're used actively with people chasing asset classes or sectors, and you want to have it in a systematic allocation within your plan.
Very good.
Sorry.
Some words of wisdom from Mike Mahoney. It's good to be back.
Professor and the
Good to be
advisor.
back.
Yes.
All right, man.
Good mix.
Till next time, folks, the Light Investor team, we're out.